Welcome back to the channel. If you have been keeping an eye on the markets in the last 24 hours, you know it has been a complete roller coaster. We are currently facing one of the most unstable macroeconomic environments of the decade. A major surge in the Middle East has rapidly increased oil prices, global shipping is facing serious obstacles, and fears of inflation have returned once again. Today, we are analyzing all the events that have occurred in the last 24 hours. We will cover the turmoil in the American markets, the bloodbath scene in the Indian markets, and the broader global and crypto developments that you need to know to safeguard your portfolio. Let's dive straight into the data. Let's start with America, where Wall Street experienced a manic Monday. The market opened in a state of complete turmoil but managed to make a surprising turnaround by the closing bell. Here are the key US closing levels for tomorrow, 9th March 2026. The S&P 500 rose by 0.8%, the Dow Jones Industrial Average increased by 0.5%, and the Nasdaq Composite led with a gain of 1.4%. At the beginning of the day, global crude oil prices briefly reached nearly $120 per barrel, a level we haven't seen in years, before quickly returning to the range of $90 to $92. Investors were fearful of the inflationary impact of these energy costs. But another major macro event occurred, the US jobs report. Shocking signs of a decline in the US labor market were observed. There was a loss of 92,000 jobs in non-farm payrolls for February. Economists had expected an increase of 50,000. Additionally, the unemployment rate rose to 4.4%. Generally, a terrible job report is bad news. But in this macro environment, bad news is good news. A weak labor market fuels the narrative that the Federal Reserve will be forced to ease monetary policy and possibly reduce the federal funds rate from the current level of 3.64% by the end of this year, giving stocks a chance to breathe. While the US made a correction, the Indian market bore the full brunt of this macro shock. India imports over 80% of its crude oil, meaning any geopolitical rise in energy prices has an immediate and significant impact on India's domestic inflation and trade deficit. The rise in energy prices is an immediate, heavy blow to India's domestic inflation and trade deficit. Here's how the major Indian indices closed. It was a broad sell-off that wiped out nearly 3 lakh rupees crore from the total market capitalization on the BSE. At its intraday low, the Sensex had fallen by nearly 2,500 points, then saw a slight recovery. The BSE Sensex closed down by 1.71%, the Nifty 50 lost over 400 points, and the Nifty Bank Index fell by more than 4%. Public sector banks suffered the most, with a decline of over 5.5% in that specific index. The Indian rupee has reached a record low, weakening to over 92.30 against the US dollar, as the rising oil import bill threatens to increase the trade deficit. Foreign institutional investors are pressing the sell button vigorously. FIIs sold shares worth over 6,030 crores rupees in a single session. So far in the month of March, they have withdrawn nearly 30,000 crores rupees. Morgan Stanley has publicly reduced its stake in Indian markets and adopted a defensive stance. They noted that Asia is significantly dependent on crude oil and LNG from the Middle East, and the market is underestimating the risks in the supply chain. The pain was heavily concentrated in crude oil-dependent and rate-sensitive sectors. Ultratech Cement, Maruti Suzuki, and SBI were all top losers, falling between 4% to 5%. However, in a classic flight to safety, investors shifted to defense sectors. IT and pharma actually ended in the green. Wipro rose by 1.7%, while Reliance, Apollo Hospitals, and Infosys all recorded gains despite the bloodbath in the broader market. Considering the global landscape, the turmoil was felt everywhere, primarily driven by the escalating conflict between the United States, Israel, and Iran. Asian markets suffered heavy losses. Japan's Nikkei 225 fell by 5.2%, and South Korea's Kospi dropped by nearly 6%. The current real gravitational center of the global market is the Strait of Hormuz. Approximately 20% of the world's total oil demand passes through this narrow choke point. Due to the closure of the waterway last week because of the conflict, about 140 million barrels of oil have been blocked from international markets. This brings us to the political shocks of the last 24 hours. US President Donald Trump made headlines with comments that affected the markets. Initially, he stated that he had no deadline to decide how long the conflict could last, causing panic in the markets. However, he quickly changed his tune, saying that the war would end very soon. Importantly for the markets, Trump announced that he would remove some oil-related restrictions to lower prices and stated that the US Navy would begin protecting tankers through the Strait of Hormuz. It was this direct intervention that cooled oil from its highest level of $120, giving a boost to US markets by the end of the day. Meanwhile, G7 finance ministers held emergency discussions regarding a potential coordinated release of strategic petroleum reserves to stabilize global energy supply, although they have currently put a hold on its implementation. Finally, let's take a look at the crypto markets, which have been extremely active. Bitcoin has taken a significant hit from its previous all-time high of $119,000. Bitcoin is currently consolidating and trading around the level of $69,000 to $70,000 as risk of sentiment spreads worldwide. In the last 24 hours, Bitcoin has officially crossed a major milestone. The mine supply has surpassed 20 million BTC, meaning that less than 8 million Bitcoins are now left to be mined. Institutional and political steps are accelerating. Reform Party leader Nigel Farage has doubled his investment in crypto, having invested 215,000 in Stack BTC, a crypto treasury firm chaired by former Chancellor Kwasi Kwarteng. Farage is seeking to make the UK a leading global hub for the crypto industry. On-chain data obtained from Arkham Intelligence has revealed that the royal government of Bhutan recently transferred Bitcoin worth $11.85 million. This brings their total outflow for 2026 to approximately 42.5 million as they periodically bring portions of Bitcoin generated from their national hydropower mining operations into liquidity. In summary, we are in a headline-driven market. For American investors, weak economic data is keeping the market buoyed against expectations of a Fed rate cut. But for Indian investors, the threat of $90 crude oil poses a very real, very current threat to domestic inflation and currency stability. Diversify your portfolio, adhere to your risk management rules, and remain defensive during highly volatile times. If you found this information useful, please hit the like button and subscribe for more daily market updates. Stay safe out there, and I'll see you in the next video.